Good afternoon, everyone. My name is Good afternoon, everyone. My name is Harry Singh, and I'm the chair of programming for the CFA Society Winnipeg. Thank you all for coming in today for this event that we are representing in collaboration with Canada Life and Northleaf Capital Partners, which is investing beyond traditional asset classes. So thank you for coming all. Before we begin, we just want to make sure that, a couple of housekeeping items. So please make sure you're on mute throughout the event. Unless you have any questions, we would be having a Q&A session at the end of the event, and you can ask those questions in the chat room or in the Q&A box even before the Q&A session starts. Before we begin, I just would like to express my privilege to my heartfelt gratitude for the first peoples of Canada as the customary keepers and defenders of this land. So we gather here today virtually on Treaty 1 territory, the original lands of Anishinaabe, Cree, OG Cree, Dakota, and Dene people, and on the homeland of Métis Nation. I acknowledge that our water is sourced from Shoal Lake 40 First Nation. I acknowledge the ancestral and unceded territories of the Inuit, Métis, and First Nation people who call this land home. We dedicate ourselves to move forward with Indigenous communities in the spirit of respect, understanding, and reconciliation. Thank you all for coming in today. Also, please join me in welcoming Chris Quigley from Canada Life, who will be introducing our speaker, Nadeem Musanji, who's the Managing Director at Northleaf Capital Partners and Canada Life. So without taking much of your time, Chris, I'll let you take the lead here, and thank you so much.
Well, thanks very much, and good morning, everybody. Welcome to Investing Beyond Traditional Asset Classes. This is presented by Canada Life and our partners over at Northleaf Capital Partners. For anybody who doesn't know me, my name is Chris Quigley. I'm an institutional investment counselor, and I have the pleasure of being your moderator and host today on behalf of the Canada Life Institutional Investments Solutions team. Now, we're here to shed some light on the importance of non-traditional asset classes. And when we say non-traditional asset classes, what we're really talking about is things like private equity, private debt, infrastructure. Now, these types of investments, they've got the potential to enhance returns and provide true diversification. And, for anybody that's been in the markets for the past number of years knows that, true diversification's been kind of hard to achieve, when we get periods where bonds and equities are performing in lockstep with each other. And so ultimately, the idea is with these types of asset classes, you as investment professionals are able to deliver higher risk-adjusted returns to your stakeholders. Now, at the end of this session, we're going to open it up to audience questions. Please feel free to think of your best, toughest question to stump our expert who's on the line today. But again, we'll collect those and we'll present them in a Q&A session at the end. So with all that said, let's set the stage a little bit on terms of what we're talking about here. And so again, as plan sponsors, money managers, investment professionals, we all know there's some factors we can control and some factors we can't control. And the factors that we can't control in these types of markets, things like macroeconomic conditions, rising correlations between investments in periods of stress, which is what we just saw. The next mega trends, or possibly the magnitude or direction of the next interest rates. Instead, we need to focus on sort of where and what we can control. And when it comes to portfolio management, obviously that starts and ends with diversification. And we're all taught, you want to get your returns up and onto that efficient frontier. And so we want to see diversification of asset classes. We want to see diversification of investment management styles and ultimately of asset management. And this is where non-traditional assets can help. And, you think back to 2022. Now in 2022, it was a year that not only saw negative equity markets, but also at the same time, we saw the worst bond year in history. Just when we needed bonds to outperform and provide that equity hedge, again, coming off a period where we were earning less than 2% on the yield on bond universe index, they completely did the opposite. And so then we enter into 2023, and we've got slowing growth, we've got a looming recession, we've got higher cost of capital, we've even got a regional banking crisis in the U.S. Instead, we get fantastic returns. And so, this surprised everybody. And, while that's great in absolute terms, as plan sponsors, the goal ultimately would want to be to smooth some of those returns over time. So one of the fundamental investment lessons we've seen over the past couple of years was really the importance of diversification beyond just the public markets. Think public equities, public fixed income, and that's ultimately where Northleaf Capital Partners is going to come into the picture. And so they're one of Canada's preeminent alternative asset class managers, and they've got proven expertise in a host of different asset classes, and that's why we've got them today. And so for those of you new to Northleaf, again, private market specialists, we've been doing this over 20 years. And that ultimately brings me to our guest speaker. It's my pleasure to introduce Nadeem Vasanji. Nadeem is Managing Director at Northleaf Capital Partners. He's a member of the executive committee. He leads their strategic distribution and marketing team, which ultimately is responsible for new product development, sales strategy, marketing, and communications. Very busy guy. Nadeem's got an MBA from the University of Chicago. I'm a little jealous because he holds a BA in economics from Harvard University, but I will say he's still working on his CFA charter. So with all that being said, welcome, Nadeem.
Thank you very much, Chris. And just can I get the thumbs up too that you can hear me and you can see the screen? And thank you to those who've taken the time to join this session. Hopefully you won't hold the lack of CFA here against me here. It really is a great pleasure to be here. As Chris mentioned, I'm with Northleaf Capital. I've been part of Northleaf for 10 years. I started my career with Northleaf on the private equity investment side of what we do, and over the years have led corporate development in my current role today, leading strategic distribution and marketing. Really, I have a few objectives for the discussion today. First, I'll provide a reasonably quick overview of the three asset classes here: infrastructure, private equity, and private credit. Those are the asset classes that Northleaf is focused on. I'll try to just describe what they are, why our institutional investors are focused on growing and maintaining allocations to these asset classes. I'll provide you with a reasonably quick outlook or near-term outlook for each of these strategies. And then I'll talk a little bit about some considerations for investors as they think about implementing these asset classes into portfolios. To start, I thought I would just give you a bit of a background on Northleaf, just to illustrate the lens that I'm bringing to the conversation today. So Northleaf, as some of you may know, we're exclusively focused on the private assets. That's private equity, credit, and infrastructure. The firm was founded in 2002, so over 20 years of history investing in these asset classes. And the platform is very much an institutional one. We have the pleasure of serving over 250 global institutional investors. And we really do have a global lens on what we do. And so while our headquarters is in Toronto, we've been investing globally since inception. And we do that from a local geographic footprint in the markets that we operate. And so that's really the lens. It's really an institutional lens here that we bring on these asset classes. So with that, I thought I would start the discussion really with some data. On the left-hand side of this slide, you can see how the allocations, in this case to private equity, for some of the largest and most sophisticated plans in Canada has evolved over the last decade and a half. And so you can see allocations, again, to private equity have dramatically increased. And so what is it that these institutional investors are looking for when they're allocating, in this case, to the private equity asset class? We'll spend some time unpacking that. On the right-hand side, when institutional investors have been surveyed recently, and this is data from the second half of 2023, as to whether they are looking to increase or maintain or decrease allocations to private equity, private debt, and infrastructure, you can see that the consensus certainly is to continue to allocate or maintain and grow allocations to these asset classes. And so what is it then that these institutional investors are looking for? And certainly this is true for the number of clients that Northleaf serves. But just to summarize it before we dig in, on the private equity side, really investors are focused on this asset class as generating the highest absolute returns in their portfolios. Generally, this is viewed as an extension of their equity investment activities, but very importantly, in addition to just those returns, bringing a significant amount of incremental diversification to portfolios. And I'll talk about how in North America, for instance, the vast majority of companies today are in fact private. When it comes to the private credit asset class, and this really has been proven out over the last 24 months in an environment of rapidly rising base rates, this is entirely a floating rate fixed income strategy. And so I'll talk about how base rates have impacted private credit portfolios. But the thesis for investors is really about strong risk-adjusted, income-oriented returns. There's a really interesting risk return benefit in the private credit asset class that we'll spend some time talking through. And again, investors generally view this as an extension and a complement to their traditional fixed income investment activities. And then lastly, on the infrastructure side, the portfolio outcomes that investors are looking for really are two things. Private infrastructure, as I'll describe, is really uncorrelated to the majority of other assets that are held in most portfolios. And so as Chris has described in his opening, that correlation amongst asset classes, infrastructure does provide a fairly unique return stream and profile. And in addition to that, infrastructure is one of the few asset classes that really has direct inflation indexation. And so, again, over the last number of years, as inflation has been front and center, that part of the infrastructure thesis has certainly been proven out. And again, from a portfolio construction standpoint, infrastructure really has sort of evolved as its own asset class. It's got attributes of private credit, or of fixed income, I should say, attributes of equity investment, and it really does have a different correlation profile. So with that, maybe as the highest level summary, I did want to spend some time unpacking each of these asset classes, starting with the infrastructure asset class. So when you think about infrastructure, really what this is large physical assets that are really essential to the operations of modern economies. Generally, these assets have monopolistic or quasi-monopolistic characteristics, and that's really what underpins the core characteristics that I described, that inflation indexation, the ability for owners of these assets to put through price increases in many cases in times of high inflation. It's that same set of characteristics that underpin the lack of correlation as well. We generally think about infrastructure in three subsections or subsegments. The first is the regulated assets. So these are assets like utilities. Often they have a prescribed or contracted rate of return that is set by a regulator. A good example of that would be an electrical utility, for instance. The second segment here would be contracted. So this could be a data center, a tank storage facility, often renewable resources like wind power would fall under this framework as well. And this really describes the contractual framework of the assets, where most of the cash flows are contracted to investment grade counterparties or a diversified set of counterparties. And then the final category here would be volume linked. The best example here is a toll road where the toll operator or the owner of the road is taking volume risk and collecting revenue on the basis of utilization of the asset. When we think about the infrastructure asset class, there really is a clear trade-off here, as there always is, between risk and return. And often a single infrastructure asset could be structured to deliver a risk return profile that might be super core, kind of at the lower end, core in the middle, or value add. And really to illustrate that, I'll take an example of a toll road. Northleaf owns a toll road outside of Montreal called the A30. The contractual framework there is really a super core framework. We operate that road under what's called an availability payment. And so long as the road is passable, in this case, the government makes a fixed payment to Northleaf to ensure that that's the case. You could take that same toll road and move it from a contracted framework to more of a volume-linked framework. And if we were to take the tolling risk, that would increase the risk profile of that asset and therefore the return that we would require. So you can take that road, take on the tolling risk, and really move it more into the core plus segment. And then similarly, if you rewind the clock, someone had to do the development, the permitting, the greenfield build out of that road. And so if you'd taken that infrastructure asset on at an earlier stage in its life, again, a higher risk, higher expected return could move, again, this very same toll road asset into a different part of the risk return spectrum. At the value added end, you're really dealing with more private equity style projects. And so I mentioned up front, one of the key benefits for investors is the lack of correlation of these private projects with broader portfolios. And I thought I'd illustrate that using a case study. This is an example of a wind farm in our portfolio in Texas. It happens to be called Canadian Breaks, which is, I guess, an unfortunate name for a Canadian-oriented firm. But it's a 210 megawatt operational wind farm in Northwest Texas. The vast majority of the energy that is generated by the wind farm is secured at a fixed price basis with a government counterparty in the region. In this case, it's a military installation. And again, the land is secured on a very long-term lease. When you think about a wind farm, it is not very human capital intensive to operate, and we will often contract to the manufacturer of the turbines on a fixed price basis the maintenance of the turbines themselves. And so when you think about a project like that with contracted revenues on a fixed price basis, a very thin cost structure, what really drives the underlying economics of this project is whether the wind blows in Texas. And so you can see how whether the wind blows in Texas, it's rather uncorrelated in the first instance to other wind farms or other infrastructure projects, wind farm in Australia, for instance, but also, and most importantly, uncorrelated from the geopolitical situation in Russia and Ukraine and the Middle East, what inflation is doing in specific markets, and other kind of factors that are more likely to drive public asset prices. In terms of some trends and themes, we're really seeing a lot of activity on the infrastructure side in a handful of subsectors: renewables, energy transition, communications, and then municipal and contracted infrastructure. Really, each of these is underpinned by some amount of global mega trend that underpins the long-term ownership of assets in each of these sectors. And so certainly the setting of ambitious climate targets, the transition away from conventional energy sources, that's really a theme that infrastructure investors are investing behind on the energy transition and renewables front. On the communication side, certainly the ubiquity of data that really is a fixture of modern life today. We certainly saw that through COVID and the move to more remote work, et cetera. Communications infrastructure such as data centers and fiber, again, a really interesting opportunity for infrastructure investors. And then it's certainly been well publicized, the amount of money that needs to go into refreshing municipal infrastructure, roads, bridges, et cetera, in municipalities in OECD countries more generally. And again, so another mega trend that we're really seeing play out and creating interesting investment opportunities for infrastructure investors. In terms of a near-term outlook, it's hard to say, whether inflation continues to persist, whether the interest rate environment, again, continues to persist at elevated rates, higher for longer type thing, or if they start to come down. I think the bottom line for the infrastructure asset class is, given the project-oriented nature, contracted cash flows, and inflation linkage, this has proven to be a very resilient asset class over the last 24 months with quite stable returns. And again, that is the expectation on a go-forward basis would be similar. And institutional investors certainly look to the asset class as a source of stable, in some cases, income, but also capital gain from these projects, across multiple cycles. So that's really, again, the infrastructure story very quickly. I'll now do a similar kind of review of the private equity asset class. Starting with the picture here, which I think surprises many. I talked up front about the diversification benefit that private equity can bring to a portfolio. And so the data here shows, the dark blue line is the number of publicly traded companies in the US. The red line shows the number of private companies in the US. And you can see how over a very long period of time here, there has been a consistent divergence, if you will, with the number of public companies shrinking and the amount of companies either staying or continuing to be private growing. When you look at that in aggregate, in companies that exceed 100 million in revenue, more than 90% of companies are private. And so when you think about the portfolio benefit from a diversification standpoint for this asset class, participating in that vast amount of value creation that is happening outside of the listed markets is really a core part of the proposition. In terms of the private equity model, and I'll show the returns in a second, but what has really underpinned the growth in the asset class, and quite frankly, the long history now and track record of successful returns, has been the active ownership approach that private equity owners and investors bring to the businesses that they purchase. Quickly talking about that life cycle of a private equity owned business, investors typically raise capital from limited partners or institutions and other profiles of investors. That investment is committed, but only called over time as buyout transactions are actually consummated. And so there's a matching process through a capital call structure where investments are funded over an investment period, typically 3 to 5 years. The owners of these businesses, the private equity sponsors, as they're referred to, then undertake significant active value creation. And in many cases, and certainly where we are focused on, is partnering with groups who have the ability to bring capital to companies that may have been capital starved, to drive M&A, invest in growth initiatives, and simultaneously bring expertise around working capital management, industry expertise, et cetera, that really allows, through a value creation phase, the driving of fundamental earnings growth at these companies. And then beyond that, there is a harvesting phase where those businesses are readied and then ultimately sold, which represents the return of capital and capital gain to the underlying investors. And a key part of this has been, over the years, a longer term orientation, certainly relative to public markets, and a strong alignment of incentives between management, between the sophisticated owners of these businesses to really drive the value creation. And so the results of this, and this is data over a 20-year period, has been quite a significant outperformance on average here relative to public equities. And again, we believe that it's really that active orientation to value creation that has sustainably driven this over a longer period of time. On the right-hand side, I try to illustrate an incremental benefit that investors do get from investing in the private markets, and in this case, private equity, which is a bit of volatility reduction and dampening. And there are a number of reasons for why valuations are less volatile in this market. You know, some of them is just related to the mechanical quarterly approach versus stocks being traded on a daily basis. But a lot of this is more fundamentally oriented valuation, where the marks represent kind of a longer term cash flow expectation of these businesses. And historically, you've just seen far less multiple expansion in the private markets versus periods of more exuberance, if you will, in the public markets. One of the key areas that we are focused on, and we have seen data prove out a return premium, if you will, is in the middle market or smaller transaction sizes. And really this does mirror, if you will, the active value creation approach of sponsors more generally. Smaller businesses, and we're still talking about businesses that might have $500 to $1 billion of enterprise value, but businesses at that size range generally have less access to capital, they have less access to expertise, and the private equity model really has shown to have a disproportional benefit at that smaller end of the market, or what is generally referred to as the middle market. And so turning, if you will, to again, another pretty quick outlook, some of the same themes here as it relates to the market environment, and Chris alluded to some others in terms of uncertain outlook, the potential for recession. Really we have seen the private equity model benefit in times of market dislocation. Here I show some data. It's called the vintage year return. So deals that were completed in years that corresponded to recessions actually have outperformed deals completed in non-recession years. And again, coming back to the fact that private equity owners have access to capital and have the ability and sophistication to really take advantage of dislocation in markets, often undertaking strategic M&A, building stronger businesses that accelerate growth after recovery. That active orientation has underpinned that historical outperformance. The last kind of theme, just to touch on quickly, is the rise of the secondary market in the private equity space. And there's a lot that's been published recently about this. Given the lack of liquidity in the market today, and what I mean by that is M&A activity in 2023 was really down about 50% year on year. And so investors in this asset class have not had as many distributions as historically. And then pair that in the backdrop of record capital commitments and fundraising, there are dynamics in the market today where investors are looking to more actively manage their portfolio, the so-called denominator effect, by selling more mature private assets into the secondary market. That has continued to be an interesting area of growth for the private equity asset class. And then we see what has been the emergence of a GP-led transaction. These are owners of businesses working with the secondary market to provide interim liquidity for investors, but retaining their ability to hold on and continue to benefit from the ownership of their star assets or best performing assets, rather than selling them to another owner or into the public markets. So I realize these are pretty quick reviews of the asset classes, but I'll move on to the credit asset class. So just a background, the private credit asset class really has been one of the fastest growing, certainly private asset classes, but asset classes more generally over the last 5 to 10 years. Today, the market's about 1.6 trillion in size and expected to not quite double, but grow significantly over the next 5 years. What's really driven the growth of this market, it really had its catalyst in the GFC, where through regulatory change, many of the traditional bank lenders retrenched from lending to higher levered situations, to the private equity market, and to the private credit market more generally. The private lending market really has its underpinnings in a more compelling value proposition to borrowers. And I'll talk about the returns and the cost of capital in a second. But fundamentally, when borrowers are looking at the private credit market, they see access to capital that is more customized and that better matches the value creation thesis for the business. And that could come in the form of delayed draw term loans or other structures that enable an M&A strategy, for instance, a more bilateral discussion around covenants, an ability to negotiate structures that match a value creation approach. Typically, the biggest part of this market really is the private equity-backed lending market, so the financing of LBO transactions and related acquisitions. And so the way the market or these loans work, and again, this really underpins what institutional investors look for, it is a floating rate asset class. And so on the right-hand side of this page, I illustrate sample economics of a senior loan in today's market. That 5.3% base rate is really what's moved from roughly 0 to over 500 basis points as the Fed, as the central bank in Canada have aggressively raised interest rates. And so all of those economics now flow to lenders on the private credit side. The loan margin is the spread or the cost of risk that lenders price. In today's market, we're really coming off a period of low liquidity, higher risk, whether that be through the kind of banking crisis, if you will. But the loan margin in today's market is just under 6% for a moderately levered senior loan. And then the last piece of the economics here are fees. And because private credit lenders are originating these assets, investors do get the benefit of that origination fee. Similar to when a bank is originating a mortgage, they're collecting a fee. In this case, it's the investors that get that benefit. And so taken all together, a typical senior loan or a portfolio of senior loans would yield about 12% gross from a cash flow basis in the current market. And so I mentioned up front, that if that was the return picture, this asset class does have a compelling risk return picture. And really what underpins that favorable risk is the downside protection, particularly in the private equity-backed private lending market. And so components of that first are, sophisticated private equity owners often have access to deep pools of equity. And so that has been and is proven to be the first course of recourse for lenders in periods of dislocation. For instance, what we observed in our portfolio through the mini COVID correction was private equity business or private equity sponsors infusing equity into their performing businesses as a way to show support and negotiate debt forgiveness in certain cases. And then the last piece is really around the loss rates historically. Each of the loans, and this is particularly true in the middle market as I've described, each of these loans typically will have financial covenant. And that is quite different from, for instance, the high yield bond market in today's environment. But those financial covenants provide an early warning system where if in the case of sideways financial performance, lenders, and typically it's 3 or 4 lenders around the table, that will trigger a discussion with the owner of the business and allow lenders to really intervene at an earlier stage. When you look at the implications of these downside protections in loss rates historically, the historical loss rate has really been about 60 basis points. And that's a little bit of a higher default rate because you do have these covenants that bite, but a much lower loss given default. And that historical loss rate overlaps more congruently with the lowest end of investment grade bonds. And so that risk return picture is a return profile in today's market of 12%. Historically that would have been in line, maybe a little bit higher than long-term averages on the high yield bond market, but at a loss rate that typically is on the low end of investment grade bonds. In terms of an outlook, we continue to see a highly compelling yield opportunity. There is an expectation perhaps of base rates coming down. In that case, you will see that reduction in economics. Again, these loans will float, and that is part of the portfolio benefit. But the rates in today's market are probably 200 to 300 basis points higher than the long-term expectation that we might have on a cross-cycle period. Over the last year or so, and certainly through the banking crisis, structures and the lack of liquidity really tilted the market in favor of lenders. We are starting to see, or we were starting to see loans get done at less leverage and higher economics. We are starting to see liquidity come back into the market, and that will create a bit of movement, I would say, in favor of borrowers from that perspective. And importantly for the market overall, we are seeing kind of transaction volume on the private equity side pick up, and that certainly is the expectation that we have in the private equity market, and that should result in a related growth in new transactions getting done in the private credit markets. A key component, certainly we continue to monitor, and the industry needs to be mindful of risk management for the loans that have been made. Many of those borrowers have worked through significant increases in interest expense over the last 2 years. So that is an area of monitoring. But even if we're certainly not projecting loss rates to get anywhere near what they might have been in the GFC, in the 250 to 300 basis point range. And there's certainly a significant amount of economic protection afforded by the high rates today in the case of any sort of change in the distress profile of the market. So if that's the private credit story, I'll now quickly turn just to a brief discussion about implementation of these strategies. And this is really an area that the market has meaningfully innovated over the last, call it 5 years or so. I described a little bit about this in the private equity section. The typical way that investors access the private markets is through a closed-ended fund. These funds generally have a fixed fundraising period where investors are committing capital. That capital is called over time, matching the sourcing of underlying transactions. Typically, that takes about 3 to 4 years to build and ramp the portfolio. And generally, that capital is locked up in the sense that there's no liquidity provisions. Investors are returned their capital after the value creation phase once transactions are sold. Increasingly, groups, and Northleaf has certainly prioritized this, are trying to introduce more open-ended fund concepts that really do simplify the administration, particularly for smaller investors who may not have access to very sophisticated treasury management systems. And there's a lot of research that's gone out related to the opportunity cost of the closed-end fund structure and some of the benefits a open-ended fund may have. Typically, these funds have predefined timelines on calls. They probably have few calls and fully ramp investors into a seeded portfolio of assets rather quickly. Often it can take less than a year to ramp into a diversified portfolio using an open-ended fund. And these funds generally will have some sort of hard lock or redemption gate, but some amount of structured liquidity that allows investors to rebalance or to exit positions over time. Really, it's important as you might be evaluating some of these open-ended fund structures. There are some reasons why closed-ended funds have been the dominant way to access these assets historically. It's really important to make sure that the liquidity on offer and the liquidity of the underlying assets, that those are matched up. Otherwise, there is significant opportunity for a disconnect there that could create some issues. And probably the other piece of it is around valuation. Open-ended funds will require a very robust valuation approach to ensure that assets are marked fairly, such that when there are inflows and outflows, that is done at an appropriate price. And then lastly, of course, closed-end funds would be blind pools, whereas open-ended funds have seeded assets, and so appropriately understanding the quality of those assets is of paramount importance. So with that, I hope everyone found that somewhat helpful. Chris, maybe I'll turn it back to you.
Well, thanks, Nadeem. Appreciate the conversation. And this is the part of the conversation where we actually turn it over to our audience. So now we'd love to take some questions from the group. Where we can, where you'll find these is in the, you can add them in the Q&A session. You can find the Q&A at the bottom on the buttons at the bottom. If you don't see it, click the three dots under more and it'll be under Q&A. And with that, I see we've already got a question coming from Harry. Given a rise in alternative markets and an increase of investments by even retail investors, do you see an overbought situation in the market? For example, asset managers trying to run the same business for investment opportunity?
Yeah, I think that's a really good question. I think we need to bifurcate that a little bit in terms of where those assets have been aggregating. There is a dynamic in the private markets where many of the new assets or that capital formation has happened in some of the largest pools out there. So the largest sovereign wealth funds, the largest pension plans like CPP, and some of the large asset aggregators like the Blackstones and the KKRs. We have certainly seen competition at the highest end of the market, or the larger end of the market, intensify. That's not to say that that hasn't been the case in the middle market, but when you look at asset flows and capital formation in the middle market, it hasn't been as large relative to the investment opportunity in the middle market. And so, generally speaking, we have not seen any sort of return compression or other indicator that the value proposition of the private markets is going to be diluted relative to those capital flows. But where we have seen maybe the most pressure is probably at the upper end of the market, Chris.
Perfect. Okay, thanks, Nadeem. So I'll throw one in on my own. We talked a little bit about interest rates and the impact, and you mentioned that private credit, you were typically seeing about a 6% on loans these days. We're entering a period where we know interest rates are coming. We don't know when, we don't know how many.
Yeah.
How is that play into not only private credit, but possibly, when we get to a lower cost of capital environment, how does that play into private equity as well?
Yeah. So I'll answer first for private credit. As described, this is a floating rate asset class, and so further rate increases or rate decreases, that will be a kind of initial order impact on returns. I think what the last 24 months have shown many institutional investors is the benefit of having some amount of floating rate exposure in a well-diversified fixed income portfolio. And so the absolute numbers continue to be quite strong, call it 12% for senior loans. We expect that type of return to continue over the near term. And then if interest rates do moderate over time, you'll see that come down to more normalized levels. 8-ish% would be kind of more typical for the asset class. As it relates to private equity, cheap financing is a good way to have generated returns over the last cycle. I think what we are expecting in the current environment is the returns to more sophisticated active management, and the fundamental kind of operational value creation is really going to come to the fore. And so we are expecting to see a decoupling of managers, where the best and the ones who are more successful on that active value creation, we would expect those managers to perform the best. Those have really relied on cheap financing, cash flow from companies to pay down debt as the prime source of value creation. Those are the types of firms that might underperform. And so, as we think about the private equity market and our orientation to finding partners, we are really focused on underwriting earnings and the ability for managers to drive earnings, and that has proven to be the successful model in dislocated markets. And I think in parallel, the successful model in today's higher cost of capital market, if that moderates, you might just see kind of that floating all boats a little bit more on the private equity side.
Perfect. Thank you. You know what? I'll throw one more at you. Artificial intelligence. Been the big buzzword this year. And if you were an equity investor, you either invested in artificial intelligence and you benefited, whether it was a company directly engaged or a company that was on the on the side providing the products or the infrastructure to support artificial intelligence. How does that play into your world and over at Northleaf?
I think that's a very good question. A lot of managers like us are starting to find ways to incorporate these tools into our business, and that could be in the asset selection side, so supporting our due diligence, and importantly, it could be in the the value creation side as well. When you take these disruptive trends, and again, I'll reserve some comments here to the middle market. When you have smaller companies that don't have access to capital and expertise, but then you bring a sophisticated owner, and in this case, it could be a sophisticated owner who has built expertise in artificial intelligence. When you bring that to bear on a business model that is less sophisticated, that is part of the model here in terms of being able to transform businesses. And so I would expect, and we saw this, decades ago with, offshoring cost structures as an example. Private equity owners would build expertise because they can scale it across a portfolio of assets and then bring the benefit of that expertise to their underlying companies. And so again, I think it's going to have implications for how we run our business as a manager. I think it's going to have significant implications for how value creation is kind of driven at the underlying company level as well. No doubt, we are needing to invest, and that will help us make better decisions over time too.
Excellent. So we got one more question in the chat here. Given your lens is global, geopolitical concerns obviously are front of mind for pretty much everybody these days, given we're seeing wars on two fronts now. How do you think about geopolitical turmoil, and how do you evaluate assets, Europe, Asia, Germany entering a recession, UK doesn't look so hot these days. How do you factor all that into what you folks do at Northleaf?
Yeah, I think that's a really good question. I think having a global lens is actually quite helpful. And just to give you an example, like in our credit strategy, it's probably we have flexibility to tilt between North America and Europe, which are the two markets that we're focused on. Through some of the geopolitical issues, that has had a disproportionate impact, for instance, on Europe. And so we're able to tilt the portfolio a little bit more towards North America. On the middle market side, generally, we are focused on businesses that are more regional rather than global. And so there is some amount of insulation there, but no doubt, some of that global geopolitical issue has kind of ripple effects. So you do factor it into the risk in the underwriting. Generally, we're stress testing, capital structures and business models. We often go back to the GFC, for instance, and would stress test the capital structure on the credit side or on the equity side to ensure portfolio resiliency. And then I think a piece of this is also around building good portfolios, and that is something that we are quite focused on at Northleaf. Is many of our investors rely on us as their sole provider, for instance, of private equity exposure. And we tend to build highly diversified portfolios that withstand, specific shocks to any single company, as an example. And so I think building a diversified pool of exposures is certainly a good way to mitigate that geopolitical risk.
Okay, thanks, Nadeem. So I don't see anything else in the chat, but I'm going to throw one last one to close us off. You manage a traditional pension plan with traditional asset classes, and you have the opportunity to add one alternative strategy. Pick your favorite. Tell us why.
Yeah, I think it's going to really depend on some contextual points that you've omitted. I think you're going to need to consider the duration of your liabilities. Private credit as an asset class, highest income, lowest kind of duration in terms of underlying assets, and therefore quicker access to your cash flow. I'd say infrastructure is certainly an area that often is missing from portfolios that haven't done private assets. And many of our institutions really focus on infrastructure as its own asset class, and I think has some really interesting diversification parameters. And no doubt, private equity is the largest of the private asset classes. So I think I answered your question by saying all of the above. I can't pick between my children as which one is my favorite, but I certainly think it needs to be anchored in the outcomes that are here on the slide. Which of these outcomes are most important to a pension plan, and ensuring that it matches the ultimate liability portfolio or profile, I should say, from a cash flow and duration standpoint too.
I'm never playing poker with you because you cheat. But thanks very much, Nadeem. And listen, let's wrap this up. Thank you very much for everybody on the line today attending. On behalf of Canada Life, partners at Northleaf Capital, we do want to thank everybody. We love talking about this stuff. This is what we live and we breathe. If you do get off this call and you do have any questions that pop up into your mind, please do reach out. You can reach us at institutionalinvestments@canadalife.com. You can reach myself at chris.quigley@canadalife.com. I can get in touch with Nadeem, and we'd love to answer any questions that you have. But on behalf of Canada Life Northleaf, thanks so much for attending today, everybody.
Thanks very much.
Thank you, everyone. This is Hari Singh again for coming out today. And on behalf of our speaker and the co-host here, Chris, for moderating this event, we'll be donating on behalf of CFA Society Winnipeg and behalf of our individuals here to Siloam Mission in Winnipeg. So thank you once again for coming out. And if you do have any questions, please do send us an email at info@cfasocietywinnipeg.com, and we'll be happy to answer any of your questions. Thank you, and have yourself a great day.